All right, let's get you exam ready for a topic that can really trip people up: intangibles, R&D, and software. We're going to break down exactly why these three are always tested together and then build a simple framework you can use to nail these questions every single time.
So you might be looking at these three different topics from the AI CPA blueprint and thinking, okay, what's the connection here? Well, it's actually pretty simple. They're always bundled together because every single exam question about them boils down to one critical decision.
And this is it. This is the big one. Do we take the hit now and expense the cost, which immediately lowers our net income? Or do we capitalize it, turn it into an asset on the balance sheet, and then spread that expense out over future periods? Every single rule we're about to cover is just a tool to help you answer this one question.
To really get a grip on this, we need a starting point, a baseline, a default setting, if you will, that you can always fall back on during the exam. And that default rule is all about how we treat research and development costs.
First off, what even is R&D? Well, the definition is pretty much what you'd expect. It's the money you spend trying to discover something new, whether that's salaries for your scientists or materials for a prototype. But here's the thing. For the exam, you don't really get points for knowing the definition. What really matters is the accounting treatment.
You know, US GAAP is pretty skeptical when it comes to R&D. The thinking is, hey, how can we be sure this cool new project will ever actually make a dime? And because that future benefit is so uncertain, you can't justify creating an asset. So what's the only other option? You have to expense the cost right away.
So let's lock this in. It's a super simple, three-step chain reaction you need to know cold. Step 1, you spot an R&D cost. Step 2, what do? You expense it immediately. Step 3, what's the impact? It directly reduces your net income for the current period. This is your default. Always start here.
All right, so we've got our default rule. When in doubt, expense it. Now let's talk about where things get a little more interesting. Our first big exception to the rule: internally developed software.
See, with software, GAAP basically says, okay, at a certain point, a project stops being a total long shot and starts looking like a sure thing. And that point is what we call a trigger point. Everything before that trigger, it's treated just like R&D, expensed. But everything after that trigger, that's when we can finally start capitalizing. And you can bet the exam will absolutely test you on identifying these triggers.
And this right here, this is one of the most important distinctions you need to master. For software you plan on selling to customers, the magic words are technological feasibility. But for software you're just building for your own company to use, the trigger is the application development stage. You have got to know these two separate triggers. Getting them mixed up is just giving away easy points.
So let's trace the journey for software that's going up for sale. In the beginning, when it's all just ideas, planning, and research, boom, expense it. It feels just like our R&D rule, right? But then you hit that magic moment, technological feasibility. Maybe you have a working model, something that proves this thing actually works. That's when the switch flips. From that moment forward, the real work, the coding, the testing, that gets capitalized. Then, once it's out in the wild, we go back to expensing ongoing costs like customer support.
Now, what about software you're building for your own internal use? It's the same kind of story, just with different chapter titles. The early brainstorming phase, what we call the preliminary project stage, gets expensed. But once management gives the green light and the real development work begins, the application development stage, we capitalize those direct costs. And later on, once the software is up and running, all the costs for training employees and maintaining the system, those get expensed as you go.
Okay, quick recap. We have our expense it now default for R&D. We have our first exception for software where we can capitalize after a specific trigger. Now let's dive into our second big exception: assets that are capitalized right from day one, like a trademark you purchase or the goodwill you get from an acquisition.
So with these types of assets, the whole expense or capitalized debate is already over. They're capitalized. They're already on the balance sheet. So the new question, the one the exam is going to nail you on, is what happens next? And the big battle here is amortization versus impairment.
And this is a non-negotiable rule you have to burn into your memory. Assets with an indefinite life, like a famous brand name or goodwill, are not amortized. Why? Well, how can you spread a cost over a useful life if you don't actually know how long that life is? You can't. So instead, we test them for impairment, which means we only record an expense if and only if its value has dropped.
Okay, listen up, because this is a classic exam trap. You have to know the difference between goodwill and other indefinite-lived intangibles. Goodwill is unique.
It only shows up when you buy another whole company. So you test it for impairment at a very high level, the entire business segment, or what we call the reporting unit. But for something specific like a trademark, you test that individual asset all by itself. That distinction is huge.
So, how often do you have to do this test? At least once a year. But also, anytime something bad happens that could signal a drop in value. You know, if the economy tanks, you lose your biggest customer, or the business just starts performing poorly. Management can't just ignore it. They have to stop and ask, is our goodwill still worth what we say it is? If there's a chance it's not, they've got to run an impairment test.
Okay, that was a lot of rules, I know. But it all fits together into a really logical framework. So let's build a simple, step-by-step process you can use on any exam question they throw at you in this area.
Here it is, just 5 steps. First, figure out what kind of cost or asset you're looking at. Second, always start with the default rule. Expense it. Third, ask yourself, wait, does an exception apply here? Fourth, if it does, you have to pinpoint that specific trigger. And finally, step 5, determine the impact on the financial statements. Let's put it to work with a couple of examples.
All right, check out our first company. They've got 3 costs. First up, $100,000 in pure R&D. Easy. That's our default rule. Expense it. Net income drops by $100,000. Done. Next, software costs. $50,000 spent before feasibility. That's treated just like R&D, so we expense that too. Another $50,000 hit to income. But then they spent $100,000 after feasibility. Aha! That's our exception. We capitalize it. So what's the impact on net income right now? 0. The total damage to the income statement this period is $150,000.
But, and this is super important, don't forget what capitalization really means. It doesn't make the expense just vanish into thin air. No way. That $100,000 is now an asset on the balance sheet. In future periods, it's going to be amortized, meaning it'll be expensed over its useful life. All we're doing is shifting the expense from today to tomorrow.
Okay, example number 2. Different scenario. Summit Harbor has goodwill on its books for $200,000, but due to some unfortunate events, its value has dropped to just $150,000. What do? This is a textbook impairment situation. The accounting here is super straightforward. The difference, $50,000, is an impairment loss. That loss flows straight to the income statement, dragging down net income for the period. At the same time, the goodwill asset on the balance sheet gets written down to its new lower value. And just a heads up, the numbers on the exam might not be this nice and round, but the logic is always the same.
All right, let's bring it all home. We've talked about the R&D default, the exceptions for software and goodwill, and all the key trigger points. But it all comes down to one simple, powerful idea you need to take with you on exam day.
Make this your mantra. When you are staring at a cost on the exam and you feel that moment of doubt, what's your default move? You expense it. Capitalization is the exception, not the rule. You only get to capitalize if you can prove you've met a specific, required trigger. If you can't, you expense it. End of story.
And I'll leave you with one final thought to chew on as you study. Remember that these rules aren't just mechanical. They involve real human judgment. Deciding exactly when technological feasibility has been met isn't always black and white. So think about it. If you're a manager who needs to boost this year's profit, are you going to argue that point happened earlier or later? Earlier, of course. So you can start capitalizing costs and make today's income look better. Understanding that gray area, that's what separates a good score from a great one.